No.
Okay. And good afternoon, everybody out here on the West Coast, and good evening for those that are on the East Coast, and good day to anybody in between. My name is Michael Filighera, and today my presentation is entitled Trading the Price Action Without Bias, or as I originally stated, trading the price action without being bullish or bearish. And now I kind of want to put a little framework around that. So a little bit about my history. I have been involved with the markets for over 40 years. I started in 1979 out here in San Francisco at the Pacific Exchange on the options floor. I have been a market maker here in San Francisco. I was a market maker also on the London traded options market, on the European Options Exchange in Amsterdam in the Netherlands. And then my introduction to electronic trading came via the DTB, which is the Deutsche Terminbörse from Germany, which was the first all-electric or all-electronic, I should say, exchange that I was aware of at the time. And so everything was computerized. And so that's where I got my introduction into trading electronically from off of a floor. I came back after 10 years. I came back to the US, came back to San Francisco. And once many things started going electronic, more off floor, then there was less of a need to have the trading floor. And so a lot of traders started going off floor to an office, to their homes, and to other places instead of being on the floor. And eventually in 2001, I joined the party and I decided I'd had enough, and I left the exchange and I set myself up here in my home and have been a retail trader since then. And by saying retail, it actually is when you are a professional trader and you're on a trade floor, then you're a member of an exchange. But the second that you're no longer the member of the exchange and you're receiving your data the same way that everybody else does, you become a retail trader. And that in and of itself has been a huge learning experience for me, but a good one. Now, I chose to stop because I continued to trade options and run options positions and sometimes large, sometimes small. And in about 2011, 2012, I determined that I no longer wanted to do that. I was not really enjoying the volatility swings that were coming really unexpected and just driving me crazy. So I chose to become a day trader. And I wanted to really learn how to be more effective in using volatility that was still available in the markets. And so now I've spent time doing that. And I've spent time developing day trading. And so I turned to the futures. And currently I continue to trade the futures, but I've narrowed it down to basically I trade the NASDAQ and the S&P, so the ES and the NQ. In the past, I've also traded the Dow, I've traded the Russell, I've traded the bonds in their various length of time. I've traded the Euro, et cetera, and even whittled that down and found that when I can really just focus on what makes a particular index tick and move, then it just really improved how I was trading. I eventually came up with realizing that the best way to actually trade the markets is to come in each day fresh, without a position, looking, going like, I'm ready, whatever they choose to do. But what I was having trouble with is I continued to go, oh, they're buying it. Why are they buying it? Who's buying it? What's going on? Why is someone suddenly turning bullish here, et cetera, et cetera? And I found that truly, by doing that, and also doing the reverse, they start hitting the market. You're like, okay, they're getting bearish. Why are they becoming bearish, et cetera, et cetera? And I found that getting wrapped up in that took me out of the mindset, took me out of my focus. And usually by the time I had figured out a possible reason why they were suddenly turning bullish or bearish, the trade happened, the trade was over, and I missed it. So I kind of started to work on my own mindset in determining that I don't need to be bullish or bearish to trade. So how am I then going to determine how I should be getting in and getting out? And that's when I began to study and look at moving averages. I started adding what you're going to see on my chart here. This is the point of control. This is the value area high, the value area low. Starting to get a better understanding of how a market moves from value area to value area. And so I just started to really look at the whole process a little bit differently. And primarily because there are many things that are happening. For example, today's very intense rally into the close, or basically the rally in the NASDAQ that we've basically have had off of the 11,068 low that we put in on the 16th of June. And from that, it's like, well, we dropped like a stone primarily because of interest rates and inflation and the Fed and doing what they needed to do to get a control of inflation, and that is raising interest rates. And how that has been filtering down, the whole inflation has been filtering down through all of the sectors, and we're hearing that coming, for example, from Amazon reporting a quarter loss, last quarter, reporting a almost $7 billion loss when everybody's expecting them to continue to blow off the doors. So it was a matter of understanding that why would the market kind of go up? Well, it's not because we've all suddenly turned bullish, and that's the best thing since sliced bread. And it's just because of we've needed to do sort of like a relief, a bounce. But does that suggest, oh, everyone's picking that as a low, the lows are in, we're now going to go and we're going to go to new highs? Absolutely not. So really, there are many other factors that kind of come into all of this. Part of this factor, we had Amazon getting ready to do a 20-for-1 split. So there's all of that readjusting. There's a lot of movement coming into the stock because many people want to participate and maybe pick up some shares. And then when the stock splits, they pick up 20 more per. If you have one share, after the split, you have 21. Etc. So it was a good opportunity on that level for people that wanted to do that. We also were working our way towards a massive June expiration on the 17th. And so that has a play as traders vie for position in terms of what price are we going to go to. And what exasperated a lot of the selling, by the way, was the fact not that everyone was suddenly turning bearish on the market, even though they had plenty of reason to do so, but it got pushed into a second higher level because in a stock like Apple, it was sliding through strike prices on expiration day or slightly before expiration day. In this case, the day before expiration, a major quadruple expiration. They're sliding through strike prices in Apple that started at 140 and slid all the way down through 130. That's 10 strike prices. That's massive amounts of adjustment that need to be done as you're breaking them. And if anybody is an option trader and you have an understanding of what delta, gamma, theta, all of those do, it was a gamma explosion. And it forces traders to adjust positions in a big way. And then what happens after we got that, we started to go up. Again, now we're going through the same strike prices, but in the opposite direction. And now we have all these adjustments going again. That brings in additional buying pressure at the time. So on the way down, going through them, we had additional sell pressure. And when you start to realize it really has nothing to do with being bullish or bearish, it has everything to do with the technicals of the market and the technicals of what's happening at the stock and that price and the options. So we have such huge amounts of derivatives across the board in just about every single stock that's traded in our indexes. there are options. Then we have ProShares has put out ultra long, ultra short on the triple Qs. Well, so there's another layer, and then each one of those has options. So when you're dealing with that amount of derivatives underlying and that are based on different things, and then you've got shifts in those, it's not necessarily producing a bullish or bearish picture. It's just producing a picture where the adjustments need to be made. And so that's kind of what I started to put together. Now I'm realizing, so I don't really want to look at a market as it being bullish or bearish. I'd rather look at it as using tools that I've always had, which help me define a particular move, help me put parameters around a move, whether it's up or down, without necessarily saying the market has just moved into a bear market or the market is back into a bullish phase. So that's how I've kind of come up with more success in trading, let me say, because without having to determine that particular bias, whether a market is bullish or bearish, and why is someone buying or selling? Why did someone just buy 200,000 shares of something? Why is this happening? So in other words, to take the time to figure out the who, what, where, when, and how, the trade's already gone. The trade's already passed you by. The move is already well underway. And so you're still going to be trying to figure it out. And then suddenly you get a downturn. Let me just kind of open, oh, that didn't work. My computer sometimes gives me a little bit of a fit. Let's see if we can do it this way. There. You can see this was interest rates, right? So we get that. And then look at these buys. Look at that buy. Look at this buying sequence. That people say, oh, that's bullish. Well, yes, because it's going up. That makes it more bullish, but they're going to want to know why. Why is everybody buying here? And what I try to explain in my own updates, which I do daily on the NASDAQ and on the S&P, that move was very localized in terms of it wasn't all 100 stocks in the NASDAQ. It was primarily two. It was Apple and it was Google. Now, Apple, simply because it's now working towards tomorrow's expiration. And so there's a play onto where it's going to go out. Apple's also the largest retail stock. So when it slipped on the 17th of June, which is just a week ago, it slipped below 130, came back above. So that's going to drive a lot of more retail in because they now want back into the stock, or they're going to pick up additional shares because, boy, that had to be the bottom. Again, not calling it to say it's bullish or bearish, but just viewing the reaction to what happened. So we get that going. Google is the next up for the 20-for-1 split. And that'll be happening on July the 15th. So that pause brings a lot more interest in because there's professional, there's firms, there's large banks, et cetera. They will pick up Google shares because they would like to have that increase. Then again, there's going to be adjustments in the options because maybe you don't want to be, you're short 5 puts and you don't want to be short, 100, because after the split, you're going to be short 100 of those puts. And so there's, again, adjustments that need to be made within options and then within the stock that create the moves without labeling it bullish or bearish. So how would I want to participate in that? Well, it's one, we're going to be realizing using my moving averages, when they start to break above moving averages, it tells me volumes about what's to come, what the follow through should be, how this should all pan out. That's one methodology. And I realized after looking at what time I was starting that the markets would be closed. So normally I prefer to do my portion of these events in a live market because it's much easier to show exactly what's happening because the market will do it. In any case, let's kind of go back over and go on to this chart. I'll just go to the 5-minute chart. So, and I want to open it up. So here we're taking a look, and now this actually is going to be picking up at, now this is my time. So let's say 11 o'clock, my time, which is going to be 2 o'clock Eastern. And here we are right here. And I felt that the market had done a nice little bounce off of this and had reached an overbought level. And I thought, okay, it could be a decent sell. So, but I need to have a greater signal than just the market's overbought on a 5-minute chart, still overbought, due for a pullback. It fits within my Elliott look that this could be at ABC. We get another nice leg down. So I'm thinking that if we start to go down, we should break below 11,546. We start, we have let me go over my moving averages for you. The orangish line, the tan line, is the 50 moving average. The blue is the 20-period moving average. This green and red line, that's VWAP. The purple line is the 200-period moving average. So, and then up here, the yellow line is the 8-period, and that blue, lighter blue line is the 4-period moving average. I use them all to give me indications of direction. And when we're coming down, I'm looking for, first of all, the 4 broke the 8, and then the 8 turned lower and broke below the 20. And as they continue to break, you'll notice, what does the market do? We're turning lower. It came down. The 4 broke below the 8. We get a little bit of acceleration. Then it continues to head, and we get another round. Then the 4 breaks the 20. We get another round. Then the 8 comes down and breaks the 20. We get another round. And then it starts to accelerate even faster. Now we're breaking the 50, 5-minute 50, but we're breaking it, and it accelerates even more. This is because as they break, there are a lot of algorithms that are attached to the moving averages, and it becomes a trigger. So if you're, and they're all if-then statements, so you could have their pre-programmed orders, but they also could be triggered by, if a break occurs below this moving average, send out that sell. And then it does. Same thing with VWAP, same thing with the 200. But they're measurements for me, because when I break one and the others are pointing so strongly down, you're going to participate. This is going to be a trade you're going to want to be in. Now, the other thing that I also have in place that helps me hold on to my non-biased trading is that I operate by and suggest and encourage people that I coach to have a set of rules. And they're not my rules, because I have my own rules, and they're applicable to my accounts, to my account size, to my trading size that I can do. They're applicable to what I look to make on each trade, what I also have, what triggers that trade. And so when I get that, I already know, get in. There was your trigger, get in. And then my last thing that I always try and actually really make sure that people understand is that you really need to have a point of where you will get out if the trade becomes invalidated. So in other words, it's a nice way of saying, where's your stop? And so I always will have the stop at the point where the trade becomes invalidated, where it's no longer going to do what the original break or the original position was telling me. So again, we get a break. I see that I'm going to sell it. It broke below point of control. It broke below the 50. I get in. So my stop is going to be right here at the top. If it breaks back above, then it's going to break back above the 50 and it's going to break back above the 8. Good enough. So, but I got in, say at 61, my stops are going to be at 68. It's a very kind of low risk, but again, people are going to have to develop what they consider to be low risk as they go through these things. Sure can. Oh, okay. What platform am I using now? The first one was Thinkorswim. And this one is NinjaTrader. And NinjaTrader is my trading platform. I also can trade off of the TOS platform, but when I'm trading the futures, I'm doing it right here through NinjaTrader. And the lengths of my moving averages, thank you for asking, Sonny, are 200, which is the purple. Then the brownish color is a 50 period. So a 200 period, a 50 period, a 20 period, an 8 period, and a 4 period. Now, major breaks are going to come via when the 20, the 50, and the 200 are broken. And that goes in either direction. It does not mean just going down, because here I'm going to show you. Here was the down move, and I did participate, and it dropped beautifully. Now, I had a target that if it got down to that 200, I will take it off. It did. I took it off. But at that same time, I'm now watching it to see, well, what's it going to do? Because it just broke it. Should I stay in? Should I re-enter? Well, it kind of played around and didn't. And then I got what is commonly known as a doji. And that, when you're using Heiken Ashi, basically tells you at the same time, be aware, tone change, be aware, could be a change here. And there was. Then they came in and bought it. Now, I need to be as careful, because one other tool that I use that I have used for over 40 years, no, actually, no, it's still 40, is the Elliott wave. And not that I want to toot my own horn, but I'm very good at it because I've spent a long time, because I've continued to use it, because I don't break the rules as laid out by Elliott, and that I use the guidelines. And I've made very, very minor changes to some of the guidelines that are more consistent with electronic algorithmic trading. So, and what makes Elliott work so cleanly, folks, is that Elliott does not measure anything but human emotional responses. That's really what creates all of the waves, so to speak. Let me just go back over here. Let me go out to the daily, because you'll see my counts. I keep my counts on here. And each particular wave, so to speak, has its own personality and characteristics. And so the other thing that is really important to remember about Elliott wave is that they are a series of building blocks. This, on a daily chart, I'm showing very large degree moves. And so we are in a corrective phase, and it's understanding that this is where the correction starts, but then you're working up to that level, to ultimately the largest degree that is in a corrective phase right now. So when I'm working it out, I work my count every day, and I update it, and I decide what, if any, changes, what's the market telling me. Because here's another major factor. I can't tell the market anything. If I could, I wouldn't need to be sitting here, because we would all be billionaires, right? There'd be nobody to trade with, because it's like, hey, I'm putting it out. This is what we're going to do today. And it goes off and it does it. That's not how it works, obviously. So I put together what I believe would be a view for upside and downside. And that's all working within what Elliott would call a preferred and an alternate view. And I carry those together. So each day I'm going to sit down and I'm going to put out where I believe a market should, or what a market's capabilities are from where we ended up closing. So last night, I looked at it and realized what we have just completed up to here was we're in a corrective phase, right? That ended on June the 16th. And here we are in a corrective phase. It's a corrective fourth wave. And what is going to happen, it has three components. There's the A component, there's the B component, and now we're in the C component. So right now, and when I made my update last night, it was right here is where the market stopped. And I was looking and thinking, there's two other things that I can really put on here. I can add a Fibonacci extension, right? So first we have Elliott. That gives me some groundwork to do. But then Fibonacci, which is another sequence, right? It's a number sequence, but there are Fibonacci relationships between the moves and between how far market will go, how far market will drop. And so I think Tony also spoke of Fibonacci. There are many different people that use it, and they use it in some various ways. Mine are connected to the actual Elliott waves, the ones how I have counted them. And so when I'm looking at a fourth wave, which will consist of an A, B, C, so there's A, there's B, and I'm looking for the C wave. Once I get the A and the B done, I can put some extensions on. Those are the retracements. These are the extensions. And that's going to give me what parameters can I put around this estimated C wave. So where can this rally phase, where can it find some resistance to complete? First important thing is, like under Elliott, all C waves are five-wave affairs, are five-wave structures. So I know I have to count that out. Well, at one point we got up to here and I thought, okay, maybe that's the whole completion of this correction. It got to a new high, it got up to levels that were resistance. And then we did that, and then they started to do this, and I'm like, no. And I ran the extensions. It told me that at a minimum, we're going to get up to here, which was resistance. 11,755 to 760 was resistance. Look where we got to. We got to 766 on a throw over. So on an extreme push right there into the close. And that the market then still started to pull back, but I don't think it's over yet. So if I'm going to be looking, I'm going to basically say, we still have potential and at least a 50-50 probability of getting up to here tomorrow. Now, I am looking for this wave to complete, and my next step would be the market turns and goes back down, and that decline should take us below 11,068. Then I'm looking for this. Now, how do I come up with that? There are very specific areas where a market will, the relationship between the waves that are occurring have Fibonacci characteristics as well. So on this one coming down, it would be where the decline in progress. Let me go out. I'm sorry. Let me go out to the daily. I don't mean to be confusing, but sometimes when I feel like, you're I did the same deal. If I'm in a minor fifth wave down, which is what all of this is, I can compare the fifth wave to the third wave. That's where I can get my extension. So I go from the top where wave 3 began to the bottom of wave 3 to the top and completion point for wave 4. Now I have parameters and estimations as to where this fifth wave can come in. So one of the more common for a fifth wave is that it will be equal in length to the third wave. That puts me at 10,197. More importantly, though, will be the structure of this fifth wave. And it'll create 5 waves of its own. And they're labeled right here in this whitish gray color. And so we have 1, 2, 3, and now we're finishing the 4. So I have still a 5th wave down. And then once this is complete, I can do it again in terms of top of wave where wave 3 began, to the bottom of wave 3, to the top of where wave 4 finishes. Then I will have additional Fibonacci extensions that I'm going to see where I get overlap. So I'm looking to where this 5th wave, this smaller 5th wave, will overlap with the larger 5th wave that's in progress. And I imagine it's going to come in, a lot of it right into these areas. So that's how I'm determining parameters that I can put around the moves. I am not calling the moves in anything. In other words, I'm not saying that the market is bullish or bearish. I am saying I'm looking for a 5th wave down. And when that's done, I think it'll be completing a larger C wave down. And then I would be expecting a very decent, sustainable rally in the form of a B wave. So not to go into depth with the Elliott, because it's going to be a lot of, like you say, ABC way too many times, Michael, and you're talking about wave 3s and 5s, and it can be very, very confusing. But understand that I'm doing this every day, and so I can put the parameters around the moves, and then I'm going to be bringing it down to my, come on, get out of the way, this one. I'm going to bring it down to my small time frame charts. I have a 1 minute, a 2 minute, and a 5 minute chart. And I'm looking to see where are my moving averages. And that's what I'm going to be looking for. And as they come down, here again, there's that, this is right into the close. We go up, we reach that extended high, right? That throw up high. And then next one down was, nope, rejection. But first thing to do, I broke the 4. That was my first clue. Then it came down, didn't quite break the 8, but the 4 kept declining. The next line didn't even really get much further than the base, and it started to decline. Broke the 8, you're in. Now this came back up, but didn't break back above the 8, so it probably held the position. Now we're in it again. So it continued higher, but rejected, hit it, declined, broke back below, broke, and then broke the 20. That produced all that. Now, I likely, being that it was right into the close, again, this is Pacific time, I would not have carried it any further. I do kind of have my own thing about, markets closed, it does continue to trade, but I think it can get real squirrely, I call it. So I would be out of all my trades then. But more importantly, you're getting the signals that we're going to continue going down. And I'm not going to stop to go, why are they selling it? Who's selling it? Why is this happening? Now let's slip over here and go to my 5 minute. Here we have the same deal, but now we're going in the other direction. We're down here waffling around. We did a beautiful decline off of our mid-morning high and down to, well, 1 o'clock Eastern. So that was a decent, nice slide and very profitable to trade even in the segments. And if you were really eager to trade, you could have traded the downside, traded the upside, traded the downside, traded the upside, et cetera, et cetera. And again, if you're bullish or bearish, you're not going to do that. You're going to sit and wait. You're going to wonder why. Okay, was that the bottom? Is this going to continue? But I'd rather approach it purely on a price action basis. Price action is going to include everything that happens in any of the component stocks in the NASDAQ. If they're truly going to come after Apple and they're just going to buy Apple, buy Apple, buy Apple, you'll see it. That's what exactly happened here. That's what happened here. They just stepped in and they're buying Apple. You will see it because it comes through in the price action. You will see it greater because if you go and you look at the component stocks of the market that you're choosing to trade, then, all right, so I want to look at this one. This is a slickcharts.com. You can go in and you're going to see what companies are in the NASDAQ, but then you get to look at the weighting. So this is going to be obviously for the close. It takes us right up into the close. NASDAQ's up 169. Now, if I want to really, why would I look at Apple? Because it carries the heaviest weighting in the NASDAQ. So right now, just being up only $2.54, it was almost responsible for 2% of that rally. Then Microsoft also, I keep an eye on. Microsoft is up 5. It was 2% of that rally. Now I got the top 2 stocks. 4% of what this market did is courtesy of them. And you can just go down the list. Tesla was the drag today. But here we have Google. It carries double because it has Google A and Google B. I put that together, you're over 7%, a 7% weighting. So collectively they were up. And what was the change? Not as big, but still enough to put enough into this. So you're going to be able to see Facebook, nice move, almost 1 5/8 of that move. So when you start to see Apple go, the NASDAQ has no choice. It will follow. It carries the heaviest weighting. Also, one better. Here's the S&P, which is 500 stocks. But look what's got control of it. Look at the top 6. Apple, Microsoft, Amazon, Google, the top 5. I'll add Tesla, right? And then I don't have to go very far before I start picking up another. So yeah, Berkshire had to move, Johnson & Johnson and United Health Group, great, because it needed some balance. There are days when the NASDAQ is really either getting smacked or really pushing higher, and the top 8 to 10 are all the tech titans. So knowing this ahead of time, I don't need to be bullish or bearish. Anything that happens in those stocks, I'm going to see in the price action. And if I'm looking like, wow, that's really intense, all I need to do is look over and see, oh, look what they're doing. Oh, see what they're buying. Again, I'm not trying to be bullish or bearish, but now I'm trying to put context around how far can this go? They're really stepping in. What I add on to that? Okay, we're down here and they come up. This was a beautiful little buy because first of all, it broke above the 4, good enough. That gives me a little clue. It started to hook the 4 and then it broke the 8. And you can see it did not turn back. Now the 4 and the 8 are rising strong. That's another clue. Follow through is coming. Follow through is coming. It's not like it's going and stopping. And now it's going to continue to decline. Nope, it's turned and it's going. And then the 4 broke above the 20. Then the 4 broke above the 200. I don't care about that. I think that's not going to upset me too much. I watched it come down and break, but it took it back quickly. So it's not a real break. It's not a, well, it was a real break because it happened, but it wasn't a sustainable break. The sustainable breaks were coming to the upside. Now, if you had taken profit, you got back in when it broke again. Now the 4 breaks above the 50. Now watch, see what they start to do. Now I want to show you something. Now this again, you're going to see more clearly on your shorter term charts that the 200, the 50, the 20, the 8, and the 4. That is what you call this NASDAQ is in alignment to go up. And when that happened right here, that's where you got long. The final piece of the pie came up and crossed above the 50. Now they're all in alignment. They're all in a row. And it just started to go. And let's just say right there, that's right here. And you just get in and you're not getting any indications to get out, because you're out is going to be again the 20. And the 20 is not turning anywhere but higher. The 8's going higher. It broke, but it didn't even phase it. The most sensitive one to anything, of course, is going to be the 4. It's the shortest. And it came down and it did. It went flat. But then, going to go up, and it just starts going. It got flat right in there in that little bit of a selling. But then it pushed higher because it's not enough to turn it. The 8 never gave us any clues. So you're getting indications, stay in the trade or get out and re-enter. I made my money. I'm going to get out. I'm going to re-enter, make more. So you're waiting for this turn, which you did get here. The 5-minute, the 2-minute wasn't as clean. The 5-minute was pretty clean. The 5-minute was like run up, rejected. See that tail? Topping tail. And I dare say that if you had a volume profile, you went in, you probably saw that there was a trap. A bunch of buyers got trapped up there. Buying on the break, and then they got trapped. And it's because it just came down. And then granted, that was just a one-off buy, but then it was the sellers were back, at least into control, into the close. And then we're seeing it after the close, seeing the same thing, where they're coming in, they're continuing to get out. Now, aftermarket, a little bit tougher, but see what it did? It came down and broke the 20. That's not good news. So again, for same thing on the way up, I'm not being bullish or bearish. Price action is telling me what direction it's going. And the moving averages are telling me that they support it, that there's enough pressure, enough volume that it's moving the averages with it. So if this was all flat, it's telling you it's not going anywhere. It's just going to sit and go boop-de-boop. Now, if I back out of this, go back over here, I add a little bit more tools. I desperately do not attempt to over accessorize or indicatorize my charts. I have seen people that come in, they're looking for coaching and they want some help, and I share their screen and I'm looking at it, it's like, where's the price action? And they've got so much on their chart. And I'm like, okay, so how do you determine whether you're going to go long or short on a particular trade? Well, if this lines up and that lines up and this lines up with that and that lines up here and this lines up, I go. And it's like, how many trades do you take in a day? Oh, not very many. I can understand why. And so you want simple, quick, efficient signals. And one other that I've added is this, which really just tells me about divergence and tells me about the moving averages and when moving averages are broken and how things are working out. Now, this is a 1-minute chart. That was a sell signal. Now, it did give the buy signal, but failed, obviously. Then it gave another one here, and it was okay. But it actually was telling us that if this was on the trajectory, it should go up and trigger there. If this is on a trajectory, it should go up and trigger there. It didn't, so you didn't get long. You just kept the short. But again, 1-minute chart. And the other thing that I want to make very clear that I think people should really grasp, if you're trading off a 1, a 2, and a 5-minute chart, your picture can change every minute to 2 minutes to 5 minutes. So you're going to be much faster. You're going to be truly a day trader. You're going to be somewhere between a scalper and a very short-term swing trader. There are plenty of swing trades you can get off a 5-minute chart, this being one. On these breaks, particularly all of them breaking back above that 200, I want it. And you could, and if you're willing to sit and hold, you had a beautiful trade. And just think about this. You got in, I'm going to call it, you got in here. Let's even give it the Dow, 11,630. Even if you didn't catch that high, if you got out here, 119 points, 119 NASDAQ points. So it's 119 times 20 times however many contracts you had. Not bad for an afternoon's work. Even if you only caught half of it, not bad for a trade. Even if you only took 20 points, you're still pulling down 100 to 200, no, 200 to 400 per contract. It's better than sitting there wondering why someone's bullish, why somebody's bearish. Why are they buying? Why are they not buying? I don't care. I really don't care. Even on Fed days, I understand that there will be a move when that Fed announcement is made. Usually, it's not one you're going to want to take. Usually, the first move, no matter what it is normally wrong. And then there'll be the second move once the Fed chair begins their press conference. That's the one you're going to want to trade. Tips of, tricks of the trade, or whatever you want to call it, tips. That's one of the things you learn. So I don't tend to not get hung up on a number, because whatever is the number is telling us, it's going to be reflected in the price action. So I don't necessarily pay any attention to finding out what that number was. I'm aware of, that we have jobless claims. We've got, employment reports. We have PPI, we have CPI, we have PMIs. We have all the different economic figures and calculations that are reported each week. And they will have their effect on a market as to whether it's going to go up or down. Well, I don't want to second guess what it is. I can let the market tell me, but I'm going to find out soon enough because the price action will tell me. Same thing in the morning. Same thing that in when we're first starting in the morning, I have to tell you, these moves are incredible. But if I sit there and I'm going to take it that here's our opening. And it was glorious. They drumped it. They just like, market opens down, down. Now, I didn't care why they were taking it down, but I'll tell you, when it came and it broke that 50, this is 10 minutes into it, I sold it, and I sold a mini. I only sold one, but I tell you that was holding it. And I remember the trade. It was 11,640 because it moved pretty quick. Got in at 40 and got out at when it came down and touched the VWAP. Because figured VWAP, and then I had the 200. I figured and actually it did. It kind of sat there and bounced a little bit. I just got out because what a profit. It was $44, 44 NASDAQ dollars. That's how I started my day today. So again, I'm not bullish. I'm not bearish because what happens? They fiddled around a little bit more, made a low, and then bought it. I'm going to do the same thing. Now, this is in a 5-minute chart, and I wasn't trading off the 5-minute chart. I was trading off of a 2-minute and a 1-minute, but you're going to get your signals even quicker. But I will run them together in terms of they're always in my sight line, right? This is in my sight line. Here's the 2. So I'm looking at where it is on the 5, where it is on the 2, and how that reflects on my 1. I like to use Heikin-Ashi because it's a much cleaner bar. I'm getting a lot of that fluff gone in terms of tail, because see how clean that is going down? No tails, little tails on the bottom, who cares? There were no tails on the top to tell you possible tone change. Watch out, it didn't happen. To all the way here. That gave you your first clue. Okay, we might have a little bounce. Again, after hours, so it's not fair to say it, but it's the same message. The same thing the market's going to be telling you no matter what time of day it is. it's always going to carry the same message. The same thing on a breakup of a moving average, depending on, no matter what the direction, it delivers the same message. It delivers the same clue about what type of a trade you're going to want to take. Value area high, value area low. They provide areas where we will likely, on this case, this is value area low, find some support. Value area high, find some resistance. What is point of control? That is the point where buyers and sellers can meet and trade openly to satisfaction right there. So that's where value is. The point of control is there is value. This value area is exactly that, a value area. Often when a market is kind of just a little sideways or just not moving massively, point of control slips below, goes down to value area low. If it holds, gets back to the point of control, then maybe there are more buyers now than the sellers. The sellers are all done. The buyers need to find the next value because they still have more to buy. So they've got to go to value to get the orders filled. You start moving. And when that value breaks it above the 20, well, I'm going to want to participate because what's the true outside? The value area high is at 3802. If they got enough to buy and they can't get it filled, they're just going to keep going. Because for all I know, that whoever coded or whoever wrote that particular algorithm that's being used maybe had to put in buy to the value area high. If you had to, and that's where it sits. How many times have we seen a market just go, or done, and down it'll come, or down, done, and up it'll go. It goes to value, and then it's done, and it comes back, it recoils back up. So the next buyer or seller comes in, and then they take the control. So I'm basically done trying to determine why they're going to be bullish. Why are they buying? What do they like? Did they like that number? Are they positive? Is this the bottom? Are they stepping in because they know that's the bottom? Or why would they think that's the bottom? To go through all of that mindset game, you're removing yourself from your own mindset. Oh, Fatima is asking, how do I set up Heiken Ashi? Actually, very easily. NinjaTrader has them available. So here I would go Heiken Ashi. I go down to my data series, and under type, actually I have it all on all of them, but under type, like before this might just be minute. And so it's just a minute trade, a 1 minute chart. And now you can see it kind of has some tails. It really isn't fair. But then when I want Heiken Ashi, I go to data series. I go under there, the type, and I go down here to Heiken Ashi. And then I put it on 1 minute or 2 minute or a 5 minute, hit apply, and boom. And then I have it. Again, that's on NinjaTrader. If you're using Thinkorswim, you'd have to go and find it where it is. You're very welcome. You need to go find it where it is. But I have about 2 minutes left, and I do want to honor that, giving David at 4 minutes so that we get set up for the next presenter. Again, hopefully I've kind of made clear, sometimes it can be very difficult to try to combine a lot of knowledge, a lot of thought process into 55 minutes. But my main point today was it is possible to trade successfully, to trade extremely successfully without being bullish or bearish, without having any bias to the market. And when you do that, you leave yourself totally free to accept whatever the market is deciding to do at that moment. Couple of premises that we all need to accept as traders. The market is always correct, and the market is always perfectly priced. At that particular time, that's the perfect price. That's where the buyer and the seller met. Hey, that's got to be a perfect price. And the market's never wrong because that's a trade and it goes on the books. So you're very welcome to say thank you. So, yeah, keep it simple is the way to go. Yeah. Yes. Thank you, Z. Thank you, because that was my point. Whew. Everybody got it. I'm so glad. Again, I'm Michael Filighera. I do have a channel on YouTube. I make daily updates, one for the S&P, one for the NASDAQ. I, again, discuss all this stuff, plus. And if you would go into YouTube, you're going to go to Traders Helping Traders, and then my name. And I asked that I always include my name because someone did hack. We own Traders Helping Traders, but somebody decided to hack it anyway. And so they've got a bunch of stuff on there under Traders Helping Traders. But if you go to YouTube, Traders Helping Traders, and then my name, you will find my channels. And the one you're really going to want to get to is I have 11,760, I believe, subscribers currently. And that's the larger channel. And it has all the information. Everything's right on there and with it. So thank you so much for joining me this afternoon and this evening. And I am happy that many had got my point.